Now, something I don't know if I ever spoke about here before is what I call the 3% move, okay? The 3% move, this is a way of looking at your portfolio and being able to tell like how risk on or off the market's going. Now, assuming you're net long in the market, right? So the majority of your positions are long, right? You're bullish on stocks. I like to look at my portfolio on a daily basis and kind of say, like, how many 3% plus moves? Because it's very natural for stocks to move less than 1%, 1%, 2%, right? But if you're talking about you got a ton of stocks in your portfolio moving more than 3%, up or down, okay, up or down, that basically shows if you're getting into a major risk on or off market, right? And so today I saw something very, very interesting in my portfolio. And the amount of stocks that made a 3% plus move upward here today, right, was a pretty substantial list, right? Fubo was a 7% plus mover. Nordstrom was almost 6% mover. Palantir was almost a 5% mover, right? Cheesecake Factory, almost a 4% mover. Tesla, almost a 4% mover. Discovery Solutions, 3% mover. Meta, 3% mover, and Revolve. That's 8 stocks. 8 stocks of mine made 3% plus moves here today. That is how brutal of a market this is if you're betting on the other side, essentially, because you're just getting this unrelenting kind of buying pressure coming in that basically says, you know, up, up, and away we go. And every time you get a major dip, it gets bought right back up. And that's been consistent for almost 9 months now at this point in time. Every time you get a dip, and it looks like, okay, maybe these stocks are going to come down a little bit more, right? It gets bought right back up, and next thing you know, a new high is reached for countless stocks out there, right? And so that's kind of the battle you've been really going through in this market, right? Now, WBA. This is a stock that's not working out for us, right? This is our position in the dividend-only portfolio, down almost 22% on this one. It has not been going good, right? Not been going good at all in regards to WBA, right? So this is year 2 of Roz Brewer, one of the most exciting, hyped kind of CEOs out there in terms of talent. And she's off to a rough start, in my opinion, here, okay? Because here we are in a situation where revenue is actually trending really well. Sales growth is strong. I mean, if you could talk about 5% type revenue growth for Walgreens, you'll take that. I'll take that as a shareholder any day of the week. Give me 5%, that's fine, okay? But all the other profitability type metrics are bad right now, man. Operating income down 26%, net earnings down 21%, and that's on an adjusted basis, by the way, not a GAAP basis, on an adjusted basis. EPS down about 21% on an adjusted basis. Right? Now, keep in mind the GAAP numbers are all screwed up right now, so that's why those aren't even really that important to look at, because year-to-date 2023 GAAP includes a $5.5 billion after-tax charge for this thing. Okay, I don't even know if I can say certain words, but on YouTube nowadays, right? But nonetheless, folks, that's huge, right? A $5.5 billion tax charge, right? And last year they had a GAAP, basically, positive thing happen for them, $2.5 billion on a tax gain on investments for Village MD, okay? So nonetheless, the GAAP numbers are all screwed up, but even when you adjust out the numbers, they're bad right now in terms of profitability metrics for Roz, which is not good, okay? As far as U.S. retail pharmacy financials go, sales were up 4.4%. That's good for this latest quarter, but adjusted gross profit was down 3.2%. That's bad, right? Comp store sales was great. So with Walgreens right now, it's complete opposite of what you would usually expect. Because in a stock like Walgreens, what you would usually expect, okay, what you'd usually expect is a situation where earnings per share is great, margins are very good, but they're having trouble growing the top line, right? And right now we have a completely opposite situation with Walgreens where the top line is actually exciting. You looked at the revenue growth for this latest quarter, that's phenomenal. And yet the profitability is in a bad place for Walgreens right now. And that's on an adjusted basis, once again. Obviously, on a GAAP basis, it's even more screwed up, but on an adjusted basis. And so this is a fascinating period to go through kind of owning the stock, right? Now, in terms of U.S. healthcare financials, that's really where a lot of this damage is coming from. The U.S. healthcare business is a money drag right now in for this company. It's a money drag. I don't think it will be like that forever, but it certainly is right now. And so I think that's something worth mentioning. And they just took down all their EPS related numbers, right? Adjusted EPS, they were expecting $4.45 to $4.65 for this year. Now they're only expecting $4 to $4.05, okay? So nonetheless, folks, that's not good, okay? So I would say Roz year 2 is off to a very rough start. Very rough start in my opinion. She's got a lot to prove over this next several quarters here, okay? Now, the one good thing with the Walgreens stock is the stock is so disgustingly cheap that there's kind of like a floor under the stock. Like, why was this stock, when you pull down numbers that much on what you were expecting versus now what you're going to do, I mean, you would have expected the stock to move more than 9% down, but the stock's already so dang cheap that there's kind of almost like a floor under the stock, right? So currently it's trading at a 4P, let's call it 7-ish, somewhere in there, right? The company's market cap right now is trading less than the equity of the company, which is fascinating because that doesn't usually happen. And so when I look at a stock like Walgreens, it is appetizing to potentially buy more shares of stock, but I do have to look at the profitability aspects, and just they're not good right now for the company. And Roz has a lot to prove in regards to this. And let's be honest, like, I own a stock like Walgreens because it's supposed to be a cash flow machine. It's a profitability machine. It's going to throw me off massive dividends, right? But when they're not putting up those sorts of numbers, you kind of do question a little bit, like, what's going on here, guys? So I'm going to listen to the conference call of this company tonight. I'm going to see, kind of more in depth what's going on, because obviously the conference calls go very in depth, and see, like, what do I want to do with Walgreens? Is this a position I want to cut? Is this a position I want to add a lot more of? Or is it a position where I just want to hold it right now and just wait over the next few quarters? So I'll get clarity from that from the conference call. Tesla, what's going on here? Stock dropped massively today, right? 6% plus downward move. So Tesla stock drops after Goldman Sachs downgrade. Goldman Sachs move follows downgrades by Barclays and Morgan Stanley. What the heck is going on here? Tesla stock was under pressure on Monday after receiving another downgrade from a major Wall Street bank, the latest in a trend that is becoming harder to ignore for investors. Late Sunday, Goldman analyst Mark Delaney took Tesla shares down a peg, downgrading the stock to neutral from buy, marking at least the third downgrade of the stock after the last week, saw analysts from Barclays and Morgan Stanley sour on the name. In an unusual move, however, Delaney raised his price target on the stock to $248 from $185, while recommending investors pare back exposure to Tesla after more than doubling this year, right? And we know Goldman Sachs has major weight, so we do know that, if Goldman Sachs comes out here and says, hey, you know what, chill, a lot of people at least consider that in the short term, okay? A month goes by, 2 months go by, no one remembers it, but at that time they do. I hate these sorts of moves, okay? I hate when somebody downgrades the stock and then massively raises their price target. Like, come on, man. Like, come on. That's just absolutely ridiculous. Ridiculous in regards to this, right? For Delaney, the downgrade is pretty much a valuation call. While the primary reason for the change in our view is that we think the market is now giving the stock more credit for its longer-term opportunities. We are also cognizant of the difficult pricing environment for new vehicles that we think will continue to weigh on Tesla's automotive non-GAAP gross margins, non-generally accepting accounting principles, gross margins this year, Delaney wrote, okay? So that's nothing new. We know 2023 is not going to be the most exciting year for Tesla's margins, so that's not really any new news there in regards to that, right? So my overall feeling, do I agree with his call? Do I disagree with his call? So I think Tesla's, obviously their valuation is not nearly as compelling now as it was 6 months ago, clearly because their stocks moved so much. I actually wouldn't say Tesla's a super overvalued stock right now. I think Tesla's actually pretty fairly valued. I think it's actually, dare I say, even slightly undervalued. I mean, very slightly. And you look at his forward P and you're like, that forward P is so high versus the market. Tesla's going to massively, epically outgrow the market. So that's the thing, a lot of people never consider is this massive outgrowing. If Tesla's going to grow 2x the market, should it trade at 2x the valuation? Absolutely. What if it's going to outgrow the market 5x over the coming years? Maybe it should command 5x the valuation, right? And so when you start breaking it down like that and start thinking on a more logical basis, the more you start to realize, oh my gosh, this stock's either fairly valued right now or maybe even actually slightly undervalued, which is interesting, right? Now, this person says Goldman Sachs wants to manipulate the market by going short while jumping in buying when prices hit bottom, making money both ways. This should be illegal trading manipulation, and the SEC should make new laws to prevent this, ban all analysis who manipulate stocks, right? And I understand this is a sentiment retail investors have. I used to have this sentiment back in my first few years of getting in the market, and you start to go down the rabbit hole more and you start to realize about manipulation in the market, and it's very frustrating, right? But at the end of the day, the SEC is not going to do anything. And you would say, well, maybe they're not going to do anything for reasons of it's their friends at the big investment banks. Things like that. The reason they're not is because you're going to start going into a lot of various things about freedom of speech and whatnot. Because if all of a sudden you say, well, Goldman Sachs can't, make commentary around this, right? and trade around this. Well, what about, the person that puts out this article? Should they be able to own Tesla stock, right? Tesla's manufacturing efficiency will continue to surge, according to this report. And whoever did that report, should they be allowed to own Tesla stock long or short, right? You get into all these gray areas, right? Because you can say, well, this must be manipulating the stock up because they're talking about all this positive stuff that we don't even know if it's going to happen or not, right? So, is that manipulative? What about this? When people put out articles like this, right? About, somebody died in a Tesla. When people die in cars all the time, every day, and it's never reported as this car, but yet it happens in a Tesla, and like it makes national news and everybody wants to talk about it. Oh, it's a crash involving a Tesla. Oh my gosh, okay? And unfortunately, people pass every day, multiple times per day in car crashes, and no one talks about it. But if it's a Tesla, it makes news, and you see it on Google, and you see it on social media, and it goes everywhere, right? Is that manipulation, right?